Welcome to another deep dive. Today we're going to be taking a look at the investment strategies of one of the world's most successful investors.
Oh, yeah.
Warren Buffett.
Warren Buffett.
And, you sent over some excerpts from Warren Buffett and the interpretation of financial statements.
Great book.
I think this is perfect for our mission here, which is to break down his strategies and see if we can apply these to anyone's portfolio, really.
Absolutely. And I think one of the most intriguing things about Warren Buffett is he's not looking for these, quick wins or anything like that. His whole approach really revolves around companies with a durable competitive advantage.
Durable competitive advantage.
Yeah.
So what does that mean? What does that look like in the real world?
So it's not just enough for a company to be doing well right now. They need to have some kind of fundamental strength that's going to keep them ahead of the game for years to come. And I think a classic example of this is Coca-Cola.
Coke. I can see where you're going with this. Everybody knows Coke. Everybody drinks Coke.
Exactly. That brand recognition that they have translates into pricing power.
Right.
They can charge more for their product because people are willing to pay more for that familiarity, that brand. And you see that reflected in their financials. They have a gross profit margin that's consistently been over 60%. And then you have companies like General Motors who have a much lower margin, struggling to maintain that same level of profitability.
So that gross profit margin, you can actually look on their statements and see that high margin.
You got it.
And that's a sign that something special might be happening.
Could be a clue that they have that it factor.
Yeah. The it factor that Buffett's looking for.
That's right.
Okay, so another example.
Sure.
You know.
And this is a completely different industry.
Okay.
Is Moody's, the bond rating service.
Okay.
They are pretty much the gold standard when it comes to bond ratings.
Yeah.
And so they have very little competition, which gives them a huge advantage.
So they're kind of in a category of one.
In a way. Yeah.
And this is how I can look and say, okay, I think this company is going to be around for a long time.
Exactly.
And maybe this would be a solid investment for me.
And Buffett actually breaks this down into three main business models that he looks for.
Okay, let's get into those.
So the first one is these unique product companies like Coca-Cola, Wrigley's, Hershey's, those products that are almost inseparable from the brand.
It's so powerful that the competitors really can't even get a word in edgewise.
It's hard to compete with that.
Right.
What's the next one?
So then you have the unique services.
Okay.
And we already talked about Moody's, but they're providing this essential service that very few companies can replicate.
Right. So it's not always about a flashy product.
Right.
It's just about filling that need in the market that nobody else can.
That's a great way to put it.
Okay. And the third?
The third is the low-cost provider.
And this one might not sound as glamorous, but it's incredibly effective.
Right.
Because they're able to offer the lowest prices.
To Walmart's.
Exactly.
Yeah.
And they're still able to be incredibly profitable.
They just dominate.
They do.
Okay, so those are the three buckets.
Those are the three buckets, and they each represent a different path to long-term profits.
Right.
So as you're kind of thinking about companies and exploring investments, think about which of these resonates the most with you.
So let's say I'm looking at a company.
Yeah.
How can I tell if they actually have this durable competitive advantage?
That's a great question. And Buffett doesn't just go on gut feeling?
I'm guessing not.
No, he doesn't. He really is famous for diving deep into these financial statements.
Okay.
I know they can seem intimidating.
Like, let's be honest, most people would rather watch paint dry than sit there with a financial statement.
But it really is the key to understanding a company's true worth.
Okay.
And he doesn't just skim them. He scrutinizes certain line items. So, for example, on the income statement, he's going to look at the gross profit margin.
Okay, and I remember we were talking about that.
Yeah.
With Coke, that's one of the things that he looks for.
That's right. If it's high.
High margin, good sign.
Good sign.
What else? What else is he looking at on the income statement?
He's also looking at research and development costs.
Yeah.
And it's not that spending money on R&D is bad.
Right.
But if a company's survival depends on constantly innovating and churning out new products, that could be a sign that their advantage isn't as durable.
They're always on the defensive.
Yeah, they're always playing catch-up.
Yeah, instead of just having that core strength.
That endures.
Okay.
Another thing that he looks at very closely is interest expense.
Interest expense, okay.
So high interest payments, it can be a red flag.
Yeah, because they're borrowing a lot of money.
Because it often means that a company's relying heavily on debt.
Right. They're building their business on a foundation of debt.
Exactly.
And what happens if the economy, takes a downturn?
Things can unravel quickly.
Yeah, we've seen that time and time again.
Yeah, we have.
Okay, so we've got Gross profit margin,
Right.
R&D.
Yep.
Keep an eye on that debt.
Don't over-leverage.
Don't over-leverage. Okay, I got it. I'm writing all this down.
Good.
I'm guessing he doesn't stop there?
He doesn't stop there. He also analyzes the balance sheet.
Okay.
And the cash flow statement.
Okay, so we've got the income statement, the balance sheet, and the cash flow statement.
He's looking at the whole picture of the company's financial health.
So the whole enchilada.
The whole enchilada, that's right.
Okay. Let's not drown ourselves in numbers just yet.
Okay.
Were there any particularly interesting insights from those statements?
Yes.
That stand out to you?
Two things in particular come to mind.
Okay.
One is capital expenditures.
Capital expenditures.
Or CapEx, as it's often called.
CapEx. All right, I've heard of that.
Yeah.
What is that again?
So that's basically the money that a company spends on.
Okay.
Things like property, plant, and equipment.
Got it. So the big investments.
Yeah, the big investments in their business.
Okay.
And what Buffett noticed is that companies with a durable competitive advantage often have lower CapEx.
Oh, interesting.
Compared to their competitors.
Because their castle's already built.
Exactly. Their castle's already built, so they don't need to spending as much money.
They're not renovating all the time.
Exactly.
Gotcha.
So the book gives an example of this Coca-Cola again.
Go.
Back then, their CapEx was about 19% of their earnings.
Okay.
And they compared that to General Motors, whose CapEx was 444% of their earnings.
444%.
Oh,
wow.
Yeah, big difference.
Okay.
So lower CapEx.
Lower CapEx, good sign.
Generally a good sign.
What was the second thing?
The second thing is stock buybacks.
Stock buybacks. Okay.
So Buffett views stock buybacks as a way to increase shareholder value over the long term.
Okay.
It's a signal that the company believes in its own future.
So when a company buys back their own stock, there are fewer shares available, and so then the price should go up.
The value of the remaining shares can increase.
Right. So it's like they're doubling down.
Exactly. They're putting their money where their mouth is.
Right.
And importantly, this is a long-term strategy. It's not about timing the market or anything like that.
Okay, so we've got durable competitive advantage.
Right.
We've got these 3 different business models.
Yes.
And now we've got these financial metrics to look out for.
Yep.
Can someone like me actually learn to invest like Warren Buffett?
You might not have billions of dollars.
Right.
But you can absolutely apply his principles.
Okay.
I think the key is to focus on quality businesses.
Quality businesses.
Those companies that have staying power.
The castles.
The castles, exactly.
Right, and to be patient.
Absolutely.
Right, and not to be scared when you see the market go down.
Don't panic when the market dips.
Right.
In fact, a bear market can be a great buying opportunity for these solid companies.
So it's like a sale.
Think of it like a sale at your favorite store.
I love that.
Right. The quality is still there, but the price is temporarily lower.
I love that analogy.
And finally, remember to do your research.
Okay.
Understanding financial statements, even at a basic level, is really essential for making these.
Right. It's about becoming financially literate.
Exactly.
Yeah. And I think that this deep dive is a great first step.
It is.
In that journey.
Absolutely.
Now, I know we're just scratching the surface here.
Yeah.
But before we go any further,
I
want to hear what stood out to you.
Okay.
So far.
Yeah. You know, for me, what really clicked was how Buffett views the stock market itself.
Okay.
He doesn't see it as this, unpredictable force that you have to try to time or beat.
Right.
He sees it as a mechanism for buying and selling pieces of businesses.
Right. You're not buying a symbol.
Exactly.
You're buying a stake.
You're buying a business.
The real company.
And that's where this whole concept of the equity bond comes into play.
Equity bond. Okay, that sounds a little intimidating.
Yeah.
Break that down for me.
So just think of it like this. A traditional bond is essentially like you're lending money.
Okay.
You get your interest payments, and eventually you get your principal back.
Right. That's generally the safe part of the portfolio.
Considered very safe and predictable.
Okay.
Buffett applies that same logic to stocks. He's saying owning a share of a company is like holding an equity bond in that company.
Okay, so instead of getting those interest payments, I'm getting the benefit of the company growing.
Exactly.
Over time.
You're hoping to benefit as the company becomes more valuable.
Right, and that's where the growth comes in.
Exactly.
Yeah.
You're essentially betting that the company is going to use its earnings wisely. Reinvesting in the business, buying back shares, paying dividends, things that are going to potentially increase the value of your equity bond.
He likes to hold those for a long time.
Yeah, it's a totally different mindset from a lot of, short-term traders who are constantly jumping in and out of positions. Yeah.
Day trading.
He wants to find companies that he can hold for years or even decades.
Right. So this equity bond idea almost helps you stay grounded.
Yeah.
When the market's going crazy.
It's a really powerful mental model.
Yeah.
And I think the book illustrated this beautifully with Buffett's investment in Coca-Cola back in 1988.
Coke.
Yeah.
They're back.
I told you they were a great example.
I knew Coke would make another appearance. What happened in 88?
So in 1988, Buffett started buying shares of Coca-Cola for around $6.50 a share.
Okay.
He saw their brand power, their global reach, their consistent earnings growth.
Consistent earnings.
And he said, okay, this is a company with a durable competitive advantage.
And that high gross profit margin.
You got it.
He loves that.
So for him, buying a share of Coke wasn't just buying a piece of paper. It was buying an equity bond in a fantastic business.
Okay.
And at that price, he estimated that he could get a potential pre-tax return of over 10% just based on their existing earnings.
Wow. So he was looking at their earnings and saying, if those stay the same,
right,
I'm already making 10%.
Right.
Just based on what they're doing now.
And he was confident that those earnings were going to grow.
Right.
In fact, he predicted that the earnings were going to grow at about 15% a year.
So that would even boost his return.
Which would boost the yield on his equity bond even further.
Wow. Okay. So it's like he can compare that to a traditional bond or to something else.
You got it.
Right.
He was thinking like a business owner.
Right.
And not a day trader.
And this was in 88.
This was in 88.
How has that worked out for him?
It's worked out pretty well. His Coke investment has skyrocketed in value since then. It's become one of his most successful decisions.
It's crazy to think that those principles haven't really changed, right?
I mean, the fundamentals of investing.
Yeah.
Stay the same. Find a great business.
Yeah.
Hold it for a long time. Ignore the noise.
Yeah.
Now, the book also emphasizes how important it is to understand how Wall Street itself works.
Oh, yeah, Wall Street.
Yeah.
That can feel like a different planet.
It kind of is. It has its own rules, its own culture, its own language.
Yeah.
The book describes it as kind of a grand casino where people are constantly placing bets on stock prices.
So is that what's happening? It's not just about, these companies?
It's not always rational.
There's another game being played.
There is. And there always has been a speculative element to the market.
Okay.
Historically, you had these figures like Diamond, Jim Brady, Bernard Baruch, who made fortunes by taking big risks.
So like the Wild West of finance.
Kinda, yeah. And while those individual speculators might not be as prominent today, they've largely been replaced by these large institutions like mutual funds, hedge funds, these big players who come in with a lot of money.
And they say they're the experts.
Right.
They can beat the market.
They're the ones who can.
Right.
And they have these fancy strategies. And they often tout their past performance to attract investors.
Yeah.
Tapping into that desire to get rich quick.
Get rich quick.
But the problem is a lot of these institutions have very short time horizons.
Right.
So they're constantly, jumping in and out of stocks, trying to catch the latest wave or the latest trend.
Right.
And then on top of that, you have these high-frequency traders who are using algorithms to make split-second decisions.
Yeah.
They're buying and selling thousands of stocks per day.
I can't even comprehend that.
It's a whole different game.
It's a totally different game.
It is.
So how do I navigate that?
Well, I think the key is to be aware that there are different games being played.
Okay.
Not everyone has the same goals.
Right.
So there are going to be those short-term speculators who are trying to make a quick profit.
Okay.
And then there are going to be those who are taking a longer-term, more business-oriented approach.
Right.
Like Buffett.
Yeah. So I think it really comes back to...
You have to know
what game you're playing.
Exactly. You have to define your own investment philosophy.
Yeah.
And stick to it.
Okay.
So if you're in it for the long haul,
right,
be patient, do your research, find those high-quality businesses.
Invest like you're buying the business.
Exactly.
Not playing the lottery.
Very well said.
Okay.
Now, another thing that the book emphasizes is that it's important to stay within your circle of competence.
Circle of competence. Okay.
Yeah.
What is that?
It basically means focusing on industries and businesses that you understand.
Got it.
Knowing your strengths and knowing your limitations as an investor.
So don't try to be a jack of all trades.
Exactly. Stick to what you know.
Okay.
So, for example, Buffett has famously avoided investing in technology companies for a long time because he didn't feel like he fully understood the industry.
Okay.
He's a value investor at heart.
Yeah.
And he prefers those businesses with tangible assets.
Right.
Predictable earning streams.
So it's okay to say no.
It is. Some things.
It's okay to say no to some investments.
Even if they're really popular.
Even if everybody else is making money from them.
Got it.
It's better to miss out on some potential gains.
Right.
Than to invest in something that you don't understand.
Right. And lose everything.
And potentially lose a lot of money.
So staying disciplined.
Staying focused.
And being honest with yourself.
Right.
About what you know and what you don't know.
So with our castle analogy.
Yes.
It's about finding those castles that we understand.
Yeah.
And that we believe in.
And not letting the market noise or other people's opinions shake our foundations.
Right.
And remember, even within your circle of competence, there's always more to learn.
Oh, of course.
Buffett is a voracious reader. He's a lifelong student of business. He's constantly trying to expand his knowledge and his understanding.
That's inspiring.
It is.
Even at that level, he's still learning.
He's still learning.
Okay. Wow. So we've covered a lot here. From equity bonds to Wall Street.
To circle of competence.
Circle of competence.
Yeah.
What stands out to you as maybe the biggest takeaway so far? For me, it's that idea of just tuning out all the noise.
Yeah.
The Wall Street noise.
Absolutely.
And focusing on the long game.
The long game.
It's so easy to get caught up in the day-to-day fluctuations of the market.
It's a roller coaster.
But he's got this incredible ability.
He does.
To stay focused on the fundamentals.
He understands that the market can be irrational in the short term, but over time, it tends to reflect the true underlying value of a business.
So he doesn't let the short-term stuff dictate his decisions.
No, he's got that long-term vision.
Right.
And that leads us to another one of his key principles. He's not afraid to buy when everyone else is selling.
Oh, really?
In fact, he sees those moments of panic as opportunities to pick up great companies at a discount.
It's like that classic line.
Oh, yeah.
Be fearful when others are greedy.
And greedy when others are fearful.
That's Buffett in a nutshell.
Right.
And the book gives a perfect example of this with his investment in the Washington Post Company back in 1973.
Okay, the Washington Post. What happened there?
So he saw that this was a high-quality newspaper with a durable competitive advantage.
Okay.
But the stock price had dropped significantly during a bear market.
So everybody else was running away?
Everyone was panicking.
Yeah.
But he swooped in.
And he bought.
He invested $11 million.
Okay.
And he held those shares for over 3 decades.
Wow, okay.
And eventually, they grew to be worth over $1.4 billion.
$1 billion. Wow.
Yeah. So that's the power of patience.
It's incredible.
Now you think about a typical Wall Street trader.
Yeah.
They might have jumped in and out of that stock multiple times over those 35 years.
Right. Made a little bit here and there.
Maybe making a small profit here or there.
Yeah.
But they would have missed out on that massive long-term gain.
So it's like the difference between a marathon runner
and somebody who just sprints for a few yards and then collapses.
Exactly.
Right.
And what's even more remarkable is that Buffett never sold a single share of the Washington Post during that entire time.
He just let it sit.
He let it ride.
And why is that?
Well, that meant that he didn't have to pay any capital gains taxes until he finally sold.
Oh, that's a nice little bonus.
It is. It's a huge tax advantage.
So that's another part of this long-term investing that we often forget about.
You're deferring those taxes,
Yeah.
so you get that extra benefit.
Okay, so obviously we can't all become Warren Buffett.
Right. We can't all be oracles of Omaha.
But are there some key takeaways that we can take from this?
Absolutely.
That we can apply?
I think the biggest one is to focus on those exceptional businesses.
Right.
The ones with the durable competitive advantage.
The castles.
The castles. Those are the companies that can generate wealth over the long term.
And then to remember that time is your friend.
Time is your friend. Let those investments grow. Don't panic when the market dips.
Stay focused. Stay the course.
On that finish line.
And don't be afraid to buy when everyone else is selling.
Yeah, zig when others zag.
Zig when others zag. Bear markets can create some amazing opportunities.
If you've done your research.
If you've done your homework and you believe in those companies.
Invest like a business owner.
Exactly.
Not a gambler.
Well, this has been a fascinating exploration.
It has.
Of Warren Buffett's investment philosophy.
We've learned so much.
We have from durable competitive advantage to equity bonds.
So long-term thinking to tuning out the noise.
Yeah, I think it's clear that Buffett's success isn't based on some, secret formula or market timing magic.
Right.
It's really about having a solid investment philosophy, doing your research, and having the discipline to stick to your principles.
Well said.
And remember, investing is a journey.
It is.
It's not a destination.
There's always something to learn.
There's always more to discover. And that's what we're here for, to help you navigate that journey.
Absolutely.
So until our next deep dive.
Yes.
Keep learning, keep exploring, and as always, happy investing.